Good evening, everyone. Just want to thank you for coming out to our second Real Deal walkthrough. This project has not begun yet, as you can tell, but 6 weeks from now, we'd love for you all to come back, take a walk through and see our finished project. We're starting next month on the 28th. A little bit of background on this project and the Real Deal walkthrough. We host once a month, just advertising our recent rehabs and acquisitions of BRRRR properties. We're doing BRRRR strategy for this property specifically. So take a walk through. It's pretty much a straight shot home, so you'll be able to see everything from right here. A little bit about what we're doing to this is we're going to potentially turn this into a third bedroom to the home. So this would be the closet space. It kind of worked out that there was one built into this. So we're going to create a hallway leading through this space right here. We were able to make it work to code to where there's an 8x10 room space right here as well. So have a look around, grab a packet. You'll be able to see on there the rental analysis, so what we can expect rental ranges, what the property was purchased for, as well as what we could sell it for after repair value. I'll pass this along to Sterling. He'll go over more about the home, the purchase, the acquisition of it.
You know, it's funny, when we started this, we had an idea, and this is kind of what I pictured, like us in a dark room in a smelly house, and it's going to be wonderful to be able to see what this beauty becomes. Oftentimes investments are done not inside of a house, but it's done inside of the numbers. And that's what we kind of will walk through, is like how we got to this point where we are today. So how many people know who Simple Wholesaling is? So Simple Wholesaling had this property for 3 months. It was on their thing. They kind of called it like a dead house at this point. I think originally it was somewhere around 49. Slowly but surely it started dropping down. As it dropped down to about 39,000, it kind of piqued my interest. And I was like, man, this is might be something, because it's that sub 30 to 50 range. It's kind of perfect for a BRRRR. But I didn't know what the neighborhood was. As you can tell, we're south of Fountain Square. So it kind of, it opens up. And when I drove up, me and Christian drove up to this house, we looked to the left, we said, what the heck is that across the street? And for the people that can't see, it's like a $500,000 house across the street, which they probably should have said that on the listing. Like they probably should have said like $500,000 across the street, and it probably would have not lasted 3 months, right? So thankfully, we were one of the few people that kind of just went and saw it, right? And when we went and saw it, we saw a street that had a lot of potential. The house to the end of the block was gutted at the time. 2 houses down, we had one that was fully rehabbed that sold for $170,000. And then across the street, of course, we have something around the $300,000 to $400,000 if he was selling it. But the guy's actually keeping it, and he's trying to buy like the whole entire block. So, you know, it opened up an opportunity for us, because he has a interest into this neighborhood. And if anybody understands the BRRRR method, having an owner-occupied neighborhood is very important to getting your money out of of it on the refi and things like that for stability purposes. So we kind of went to Brian. I went to Brian, and we had investor. Me and Christian drove around. He came. He said, I'll buy it today. And the guy that we talked to before that actually purchased it within seconds of him seeing it. So it opened up this opportunity where one of our investors, Mike, bought it for $35,000. As you can see, kind of what Alexa was saying is just a rehab, which for the people that's online and things, you will see that. I will post the whole package for you so you can work through it by yourself. The rehab quotes that we got it's kind of in the middle of this package. Sorry, if I can flip to it.
I'll say we were very fortunate with the rehab in this home. We had 6 quotes pulled. They all range between $18,000 to $24,000. We do have a contractor that we've repeatedly used for multiple rehabs recently. So he came through and he's doing the project for right under $12,000. So it definitely was a blessing to us as well as the client to be able to come through because of a good relationship and offer him a lower price on the rehab. So you'll see the quote listed, the very last one. This is the one that we're going to follow through with.
And you can see, with understanding the BRRRR, we say the BRRRR. The BRRRR stands for the buy, the rehab, the rent, the refi, and then repeat, right? So with this, you're going to see 2 different quality of quotes. You're going to see one that's very detailed. You're going to see one that's kind of like vague and not as detailed. And that says a part too, right? So don't be alarmed by the person that's not necessarily detailed today, because that opens up opportunities later, if you understand what I'm saying. Sometimes people just give us a gloss over and say, hey, I can do it generally for this price. So the first one, of course, he understood interior wall, carpet removal, remove and replace all disfigured flooring, repair roof of the front porch, remove and place siding, reframe. And that was 18.7, which is probably online, but of course, like I said, his quote wasn't as detailed. So it kind of leaves room for opportunity, right? So this is kind of why we work with the guy that we chose to, is because how detailed he was. Like when it came down to the exterior, the deck, the door, the roofing, the gutters, because for the burr, there's certain things that you have to make sure that you do to get to that mark, right? When it comes down to, as you'll see, what I said the after repair value is about 105. So with the after repair of 105, we have to make sure that we are repairing the house to a certain standard. The comps in this neighborhood range from anywhere from 30,000 to 300,000. Realistically, when I looked at the comps, we were somewhere around 100 on the after repair value to 180. I'll always go to the worst case scenario so that I don't get stuck with it later, if that makes sense. If I get 105,000, great. If I get 179, I'm taking everyone for steaks. Like, you know, like that's kind of the difference of what we shoot for. When it came down to the rent range, kind of the same thing. We saw anything from 700 to 800, but then we saw some at the 1,000 mark, which that seemed kind of like a wild card, if you understand. So I kind of, we understood that it was probably going to be about that 700 to 800, so that we didn't over promise and under deliver here. But the numbers work great when it comes to our cash on cash. Our gross rent multiplier, which Lee will talk about, and why it's the number it is going to be important. But looking at our rehab quotes. So this one is for what was the total on this one? Let's see. Sorry. 11.5, yes. So 11.5, like what Alexa said, this is kind of like one of those preferred vendors we work with. So it's like he gave us his best possible deal, because he probably made about 200,000 on us from work that we have given him all year, which you kind of got to love when people appreciate your business, right? Like somebody's not just like keep on marking it up, because that can happen. So that goes to a point of like growing with your contractors. Like everybody loves bids, right? So give your contractor something. You know what I mean? If you're just going to be giving these bids and things and you're having 3 to 4 people look at it, what's $50? You know what I mean? What's $50 for those people out of their time to make sure that they don't get burnt out from all the multiple quotes that you keep asking them to go to? Because after a while, what are they going to do? They're going to be like, nah, man, Sterling calling again. He just want me to bid against the other guy so that he can get it lowered. So we got to make sure that we're very careful and we respect the people's time. So yeah, it's 11.5. The building of the room is in here. Like I said, they're going to knock out this. What we figured is a 3-bedroom, 1 bath, which we're looking into trying to add a half bath, which is not in the quote. But a 3-bedroom, 1.5 bath is a better value in resale at this price point than a 2-bedroom, 1.5 bath that is more open in the concept, just because based off of the neighborhood and the things that we saw, right? It's already a smaller house. It's only about 800 square foot. So you have to have something that drives it. It doesn't have a garage. We're not going to build a garage just because at the end of the day, it's just not cost effective to build a garage. The garage would add somewhere around 10 to 15,000 on the value of the house on the after repair, but that 10 to 15,000 is not worth the percentages that makes it worth it, in my opinion. All right. So we are changing out the carpet. Like I said, you have to make sure that you are on target of the neighborhood when it comes down to these rehabs. So if the neighborhood, everybody has laminate and you go carpet, you won't get the value that you're looking for. If everybody in the neighborhood has carpet and you have laminate, that never happens, so don't worry about it. But it's very important to make sure you stay on target, as well as colors. Colors are very important. Alexa does a lot of that because, you know, I'm not really that fashionable and stuff like that. So you just have to make sure that you're on target. Like, you know what I mean? Don't put a light blue, then it's really gender neutral things are very important for the rehab.
We have found doing turns after tenants moving out, vinyl is honestly the best option. You do pay a little bit more up front, but at the end when a tenant moves out, almost 90% of the time we do have to replace the carpet. So installing vinyl up front can be money saver in the end. So that's something that we do suggest for all of our rehabs, either vinyl planks or actual laminate flooring.
Or vinyl sheet.
Or vinyl sheet, yeah.
And that'd be pretty durable.
Yep. All right. Anybody have any questions when it comes down to the rehab, how we got to it, the numbers? So now I'm going to pass it over to Lee. Lee's going to kind of walk you through the analysis of this property.
I like to analyze properties. I spend a great deal of time doing so. There's various metrics that I use that are just kind of helpful. One of the quick ones I use is known as the gross rent multiplier. So you take the gross rents and divide it by the asset or the purchase price of the property, and then that gives you a quick ratio. So in this particular property, if you were to take 32,000 and divide it by 800, that's 9,600, you would get a ratio of 3.33. That's a pretty low ratio. So what does that ratio mean? What it means is how quickly does the cash flow rebuy the entire asset. In this particular case, it would take 3 years for you to be able to generate that, what it costs to buy it. So for me, I find that the best ratios, and I have a range personally, and this is my own personal desire, or what I think is safe and good. And you have to decide on your own what you think is best. So for me, I don't like ratios that are obviously higher than 10, because that means it would take 10 years of cash flow to rebuy the whole asset again. And I don't like cash flows that are below 3 or in that 3 that I find it, or lower, I find it a little questionable. It's like, okay, what's wrong with it? Is there something crucially wrong? Because why would someone sell something for so cheap? I expect skeletons. That doesn't mean the deal isn't a possible deal or even a really good opportunity. It's just you have to be wary. Anytime the ratios are below 4, you need to look to see, okay, I should assume something's wrong with this, that there's a skeleton somewhere, and look around for it. And the gross rent multiplier is a very simple ratio. It's just a quick thumb ratio. That's not a ratio you want to use to actually buy the property. It's just you look at the property now that pass, move, and then go in deeper. But if you do see a lower ratio and the 3s are lower, then you should question, okay, what's wrong with the property? Well, why is it selling for so cheap? In this particular case, it's because it needs, a significant amount of rehab. So obviously that it needs that. And so you need to make sure you are paying attention in the inspection, and then also a good contract that you trust and know to look at it and make sure there's nothing wrong with the foundation, that there's nothing that's just critically wrong with the property in and of itself. So that's important. So once we factor in the rehab cost, which is about $20,000, that brings it up to the total project cost of $53,000. In that case, the gross rent multiplier is a 5.57. That's a much healthier ratio. That's a safer ratio, I would say. And that should deal with any skeletons in the closet or any issues that may or not pop up. So that's just a really quick ratio. That's not, you shouldn't use that again as your final number. That's far from it. You have cap rate, cash on cash return, and return on investment. These are much better, more in-depth ratios. So for the capitalization rate, and I'll just read you a basic definition of what it is. The capitalization rate is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment, or to determine the fair market value of the property. So you can use a cap rate one of two ways. One way is determine, if you have the net operating income and then you divide it by the purchase price, you'll get a ratio or a rate, and that whatever that may be. So So, and it's important to figure out your net operating income. In this case, you're switching from gross to net operating income. And so net operating income is subtracted from all of your operating expenses. This is the most important number you should be able to figure out, is what is your actual your operating expenses subtracted by your gross scheduled equals your net operating income. You need to figure that out as an investor. That's critical, being able to calculate all your ratios. Now, of course, you're not going to have an exact number or know for sure what your vacancy is going to be, what your turnover expenses are going to be for sure, but you need to try to guesstimate. I use a percentage model is what I use. So I assume, depending on the area, if the area is rougher, I assume a higher percentage of the total rents. So I do like 10% of the rents or 10% expected vacancy. That's, at 10% you're expecting, every year that you're going to have 2 months roughly out of the year where you're not going to have anyone in there. Kind of high, but it's better to overassume the expenses. So understate the revenues and overstate the expenses. You're more likely to be safer as a result. And if the deal still works, if it still works in that scenario, then you are covering yourself. You're being safer as a result. So it's important to figure out your net operating income. That is the number you need to know, because that allows you to calculate your cap rate, your return on cash, and your return on investment. So in this particular case, you have a purchase cap rate of 17%, and the reason why that is so high is because, well, it's kind of obvious. It's $32,000. So at that point, you have an $800 cash flow for a $32,000 purchase. So it makes the purchase cap rate look really high, 17%. In reality, you're going to have to put in rehab to get that $800 in rent. So you're not going to just get that. Right now, who would pay $800 for this right now? You wouldn't. So you would have to rehab it. That will drop your effective cap rate. In this particular case, it's what they're saying at Bigger Pockets is like a pro forma of 5%. When I calculated it, I got a cap rate of more around 10%. So I'm not exactly sure how they calculated it. I think they're using cash on cash as their form of a cap rate. But yeah, I got a 10% cap rate on this property. So it drops by 7% with that $20,000 rehab. Now you see their cash on cash ROI, which is 10%. And that's pretty close to their cap rate. And so because this property is so cheap and they're not using any debt as far as I'm aware of, nope, so it's all cash. So that's their cap rate and their cash on cash return are basically going to be the same thing. So you start seeing a discrepancy or a difference between cap rate and cash on cash return when you start factoring in debt. One ratio goes up, so cash on cash return starts dropping because you have an expense, and cap rate starts going up. So the cash on cash is at 10% in this case, and you can simply calculate that by taking net operating income and dividing it by the total cash invested in the asset. So you take the $53,000 and you divide it by the net operating income. So in this case, it'd be $53,000 divided by, or the other way around to get the ratio. So 5,614 divided by 53,000 will give you a 10% cash on cash return. So I mean, that's pretty much the statistics on this property. It has a good cap rate, 10%. It has a cash on cash return of 10%. So this should be a good return, and that doesn't even factor in the final sell value of this, which I do believe 105 is on the conservative side, as a matter of fact. I've seen comps with Sterling that were around 117 close by. It does really range kind of around, but I do think 105 is very realistic. And that's it.
Any questions?
Yes.
So for expenses, you don't do anything as far as CapEx, percentage for that, or anything?
You can, but that's not. Yeah, that's a great question. So CapEx is not an operating expense. It's actually separate of, but you absolutely should factor in CapEx and also maintenance, of course. So that's CapEx is separate of maintenance. So you should factor in your operating expenses, maintenance, vacancy, turnover, utilities if you have to pay any. Generally, tenants pay them, but sometimes, depending on what type of property you have, you may have to pay them, and just various things like that, HOA, whatnot. But, yeah, but CapEx is generally considered separate, and you should stick money aside specifically for that.
Is there a percentage you don't use? Or?
Yeah, actually, I do. It depends on the property. So if you think it's a property that needs more, you have, some deferred maintenance or things that are like a roof, you know it's going to need to be replaced in 5 years, but it doesn't need it now, then you should set aside more money. And in that case, maybe you need to assume 10% of the rents and put that aside. But if it's a fully rehabbed and nothing in the next foreseeable future, maybe you want to drop that down to 5 or 4. It just, you have to know your property and how that's going to work.
And that's a good point. For the Burr properties specifically, we're going to rehab and make sure that the furnace is new, the water heaters are new, all the major appliances will be new. So the CapEx would go down, if any, for the first foreseeable future because of warranties and things like that.
Yeah, absolutely agree. That's the nice thing about the Burrs. You're getting everything out of the way right now. So you don't need to budget much for the CapEx. And then even with that, your maintenance expenses could be less because, well, I've fixed everything. So there's a good chance that nothing big will come up, or even just minor things. And when something's new, it's more durable than when it's old. So you might even be able to assume a lesser maintenance expense. But again, I would overstate your expenses, understate your revenues. And if the deal works, then you got a good deal. Don't try to make your numbers work. It's so easy to do that. I have been fooled into, you can make any property look good if you manipulate the numbers.
Yeah. Anybody else? So Lee made a good point when he started talking about and this is applicable to wholesalers, to buy and hold investors, everyone, right? We look at thousands of houses a day, right? We look at thousands of houses a day. How do you figure out which one is the best house today, if that makes sense, right? And how we do it is things like the gross rent multiplier, where you can say, this one won't work just off the surface numbers.
Yeah.
And so even for wholesalers, like if you're looking at properties and you're trying to figure out, is this a good buy and hold for someone? Or is this a good flip for someone? Gross rent multiplier is a great way to figure out, and normally it's used a lot in like commercial deals. So this is a great way of just being able to utilize it and be able to figure out really quick if this is a good buy and hold for someone.
Yep, I think it is a good ratio for that. But then you want to go into more depth, cap rates.
Yep.
And, again, with that cap rate, you can either use the cap rate, like this area, let's say that the determined cap rate is 8%. Then you could take that cap rate and then divide it into the purchase, or by the cash flows, projected cash flows, and that should tell you how much you should purchase for an asset. So you can use it in the reverse.
Just a question, because I know you guys are thinking it. No, you're not. But Lee, can you talk about area cap rates?
Yeah, that's what was going on.
Yeah, see, told you.
So, yeah.
I figured out like 8% here. How do you figure out that?
I was just guessing that number, but actually that is a really good question. And so what is a cap rate? Basically, the area cap rate is what all the investors or people perceive as a norm. So if everyone believes that, let's say I say this area is an 8% cap rate, and you say that to everyone, then eventually enough people believe it is the area cap rate. But generally speaking, so this property has like an 8% cap rate, or excuse me, a 10% cap rate. So if you were to do a lot of properties in this area where it seems like that's the norm, then you can make the assumption that, this area commands a 10% cap rate based off the property values, and you can reverse it. But the only way you can do that is if you look at a lot of deals in a specific area and see what they naturally, you look at the rents, you look at what their asking price for these properties, and that pumps out a cap rate of return. So then if you do that in enough area, this house, that house, then you would intrinsically know, you should expect a 10% cap rate. And so you can reverse it and then use the 10% divided by the cash flows, and then you get the purchase price. So they both require work. It just requires you doing calculations over and over again.
And I think it's very important, and I think I'm very thankful for everyone that came here, because these are the things that you learn in CIREA, Central Indiana Real Estate Investor Association, right? Is cap rates, how everyone works deals are so different. So how we do it at Ethosity and how Lee does it at SPI are different. But you start pulling from different things, you're like, I like how that works. Mm-hmm. I like how this works. This person's doing notes, then I'm going to learn about notes. Or this person's doing buy and holds. So I'm really thankful for the support at Syria as well for these things in the education of it. Anybody else have any questions? So another thing that we talk about is with burrs is having the end in sight. So making sure that you have, if you're going to do a burr, what do you have to have at the end of it?
Your exit strategy.
You have to have your exit strategy. Thank you. So with the burr, the exit strategy is for you to refinance it. So I really hope that what I push people to do is when they're going into the project, you know what the end is. So working and trying to figure out what type of person that can help you refi this house even before you purchase the house. Because there's things like seasoning periods that you have to understand. It's not as easy as just getting out the house or selling the house. You have to make sure you understand. So there's a lot of great banks, local banks in Indiana, that can help you with those exit strategies and you can build those relationships with, right?
Another thing on that note actually is you got to keep in track of your expenses on the closing costs, because you know whether you used a hard money lender or cash, especially if you're using a hard money lender, there's expenses there, there's the upfront capital, there's requirements for that, and then you have the refi. So just factor that into your model, because that's an expense, so it. You can even find that out from the bank even before you purchase the property. So that can be a factored in expense.
Especially because, man, I don't like jumping on hard money lenders, but Lee always says hard money lenders are called hard money for a reason, because they're hard.
Yeah, yes.
Because
it's a hard deal to do.
If you're doing 12% on this deal, the holding
4 points
cost
up, yeah,
is crazy, right? Like, you know what I mean? Like, go to Tyler, he'll loan you some money. Like, but the holding cost becomes crazy, So you have to make sure that you understand what that is and how soon you can exit from it especially if you're using things like hard money or having debt period on something like a burr strategy.
Yeah, you want to make sure it's as short as possible, whether it's a 3-month seasoning period or 6-month. And really, hard money lenders don't want you holding their loans for longer than a year anyhow. They're very uncomfortable with that. Oh, and then another limitation with hard money is you have to make sure that your purchase price and the rehab isn't higher. So if you bought a house for $50, you can't do a rehab for more than $50. They just won't do the deal. They're unlikely to do the deal.
It's just higher risk.
Higher risk.
They loan on the asset, not necessarily the person.
On the deal or the person, yeah.
Yep.
Go ahead.
How long does it usually take for you to refinance? How long do you have to wait before you refinance?
So it depends on the bank. Some banks have what is known as a seasoning period, where they need everything just to remain still and reliable and not changing. And some banks it's 3 months, some it's 6 months. I've seen some as much as a year, which I think that's crazy. But typically you should expect a 3 to 6 months, somewhere in that range.
Yeah, I mean, if you do it cash, that's different than financing, right? So a cash deal, sometimes, it used to be that you could do those and turn over pretty quickly, as low as like 3 months.
Yeah.
But if you don't do cash and you're using some form of financing, like a line of credit, me and Tyler working a deal and it's a line of credit. I probably shouldn't say this on camera, but I'm going to say it. And the guy is like, hey, I have an exit strategy of this, and Tyler makes a good point. He calls me, he's like, hey man, what's the seasoning on it? I'm like, that's a great question. Because how are you buying this with this line of credit? And sometimes with those line of credits, they make you have a seasoning period. So if you bought it cash, now they let you, refi or get out of it with that line of credit in 3 months. But if you don't hold it for so long, you can't do it. You know what I mean? So it's kind of that catch-22 of just different financing and really understanding your financing going into it.
Yeah, with cash, chances are you can refi faster, obviously.
Right.
Yeah, it's just the nature of how
I'm a little confused. If you bought it with cash, why do you want to refi anything?
If you want to get your money back out, that's part of the burr. So for the burr strategy, you don't have to. If you're just doing a true buy and hold, you keep that money in there, and that way you're getting your cash flow. But if you're doing the burr strategy, then you want your money back out. Not all of it, but let's say you want 80% of your money back out so you can do the next deal and repeat. And that's part of the burr strategy.
So for example, like this deal, This deal, 32,000 with 11,000 rehab. You're looking at somewhere around, say, with closing costs, everything about 43, 44,000, right? So with an after repair value of 105, you can now take that money at a 70% because the loan
to LTV usually 75 or something.
Yeah, somewhere
70.
around that. You could take about 75% of that and leverage it. We always caution people on leverage, just because you don't want to get upside down or over leverage and things like that.
Or you don't want your cash flows to go negative.
Absolutely. That's a huge one. Like, honestly, when I ran a couple numbers, when it goes negative, you have to be very careful. So it's a reason why it's kind of the idea of how much can you stretch a dollar. And that's why you have to be very careful, because at some point the dollar becomes like a rubber band. If you stretch it so much, the integrity of that dollar becomes weaker. So you have to be cautious of it. It's not a magic pill so much, because it can work, but it's not a magic pill.
Yeah, I agree. So sometimes it is best to not refi your money or not refi as much. But the limitation of potentially not refining, if you only have a limited source of money, is not being able to buy another deal with cash again. So you have to weigh those options. I'm not a fan of refining to the maximum level. I don't think you should. You should find what is the healthiest number. Maybe it's 50%, maybe it's 60%, maybe it's 40%. I don't know what it is, but you have to determine that as an investor.
Yep.
I'm just gonna throw something in here. Because Sterling and I were talking about this earlier, but regardless doing the refi strategy, it's always good. But the reality is, you never can go wrong opening up a line of credit on an investment property. You don't have to use the line of credit.
Yeah.
But if you open one up, you can take advantage of what credit you do have at that given time to pull the equity out of a deal. And then if a great deal does come along, very well your whole mindset might change. If there's just this killer deal down the street and at that point you don't have the money sitting around your savings account, well then use that line of credit. It's just like a credit card.
Yep.
So, and especially in investing, if you got credit and you have it right now before you kick your job, take advantage of it, load it out, max out your credit, do everything that Dave Ramsey says not to do. Don't use it unless if you need it. And lines of credit, they can be a great thing. But like Sterling says, if you overuse it, or if you start using it for personal things, or you start making bad decisions, you're going to get in trouble really quick.
Yep.
And I know some people right now that have done that. But it's a wonderful tool to have, especially in this world of real estate.
And they're pretty flexible. What is Finance of America? Dude was like, hey, if you show 50,000, I give you $500,000. I was like, what's your credit score got to be? He's like, 625. I'm like, what?
That's nothing.
That's nothing. That's nothing when it comes to, hey man, I'm dark skinned. You got to really make sure I got the light. No, so like I said, Finance of America is a great alternative, right? They're like, hey, if you can show this, and they said they only check it one time, which is really great. And then like Tyler said, you only use what you need. You know what I mean? Don't use the $500,000 to go buy all this stuff. Use it on that deal, figure out what your end is, and leverage it and build from it. And I think the bird strategy, the buy and hold, the flip, it's all just a strategy to build wealth. And that's what we're here for, is to build and teach how to build wealth.